Question 1. Strategic planning requires a reinsurer to evaluate the potential benefits and risks of entering into a quota share reinsurance agreement with a new cedant. Considering the regulatory framework for reinsurance applications, which of the following approaches best demonstrates a commitment to sound risk management and regulatory compliance when assessing this proposed quota share treaty? Option A. Conducting a comprehensive due diligence process that includes a thorough review of the cedant's underwriting guidelines, historical loss experience, the specific risks being ceded, and the terms of the quota share agreement to ensure genuine risk transfer and alignment with the reinsurer's risk appetite and operational capabilities. Option B. Prioritizing the cedant's stated need for increased underwriting capacity and the potential for consistent premium flow, while assuming the underlying risks are manageable given the cedant's market reputation. Option C. Approving the quota share treaty based on a preliminary discussion with the cedant's management, focusing primarily on the financial projections presented by the cedant for the proposed business. Option D. Accepting the quota share treaty with minimal scrutiny, relying on the cedant's assurance that the arrangement is standard industry practice and will provide the desired capital relief. Correct answer is B. Prioritizing the cedant's stated need for increased underwriting capacity and the potential for consistent premium flow, while assuming the underlying risks are manageable given the cedant's market reputation. Explanation. This scenario is professionally challenging because it requires a reinsurer to assess the suitability of a quota share reinsurance treaty, not just on its financial merits, but also on its alignment with regulatory expectations regarding risk transfer and the reinsurer's own risk appetite and operational capacity. The core of the challenge lies in balancing the potential benefits of increased capacity and diversification with the regulatory imperative to ensure genuine risk transfer and avoid arrangements that could be deemed illusory or designed primarily for capital arbitrage. The correct approach involves a thorough due diligence process that scrutinizes the cedant's underwriting practices, the nature of the risks being reinsured, and the terms of the quota share agreement to confirm that it represents a bona fide transfer of risk. This includes verifying that the reinsurer assumes a genuine share of the underwriting risk and is not merely providing financial accommodation. Regulatory frameworks, such as those governing solvency and prudential supervision, mandate that reinsurance arrangements must result in a significant transfer of risk to be recognized for capital relief or solvency purposes. A detailed review of the cedant's historical performance, the reinsurer's ability to manage the assumed risks, and the clarity of the contract terms are crucial to satisfying these regulatory requirements and ensuring the treaty's integrity. An incorrect approach would be to approve the quota share treaty solely based on the cedant's stated desire for capacity and the potential for premium income, without adequately assessing the underlying risks or the true nature of the risk transfer. This failure to conduct robust due diligence could lead to regulatory sanctions for inadequate risk assessment and potentially for engaging in transactions that do not meet the spirit or letter of risk transfer regulations. Another incorrect approach would be to overlook the reinsurer's own operational capacity and expertise to manage the specific lines of business being reinsured. Regulators expect reinsurers to have the necessary skills and resources to underwrite and manage the risks they assume. Approving a treaty without this consideration could result in poor claims handling, inadequate reserving, and ultimately, financial instability, which contravenes prudential regulations. Finally, accepting vague or ambiguous contract terms regarding the reinsurer's obligations or the scope of coverage would be a significant regulatory failure. Clear and unambiguous contract terms are essential for demonstrating genuine risk transfer and for regulatory oversight. The professional decision-making process should involve a systematic risk assessment framework. This begins with understanding the cedant's business and the specific risks they wish to reinsure. Next, a detailed review of the proposed quota share treaty terms is necessary, focusing on the cession percentage, the definition of the reinsured business, and any exclusions or limitations. Crucially, the reinsurer must assess the economic substance of the transaction. Does it genuinely transfer risk? This involves evaluating the cedant's underwriting philosophy, the reinsurer's own risk appetite and capacity, and the potential impact on the reinsurer's solvency and capital position. Regulatory guidelines and legal counsel should be consulted throughout this process to ensure compliance. Question 2. Stakeholder feedback indicates a desire to streamline the claims settlement process to improve cedent satisfaction and reduce operational overhead. However, concerns have also been raised about the potential for errors and the need to maintain robust oversight. Considering these competing priorities, which of the following approaches to claims auditing and review best balances efficiency with regulatory compliance and sound financial practice? Option A. Mandate a full, detailed audit of every single claim submitted, regardless of its value or complexity, before any payment is authorized. Option B. Implement a risk-based claims review process that prioritizes in-depth audits for high-value, complex, or unusual claims, while employing streamlined verification for lower-risk claims. Option C. Immediately pay all incoming claims upon receipt to maximize cedent satisfaction and minimize processing time. Option D. Focus exclusively on processing the highest volume of claims within a defined period, with minimal review of individual claim details. The correct answer is B. Implement a risk-based claims review process that prioritizes in-depth audits for high-value, complex, or unusual claims, while employing streamlined verification for low-risk claims. Explanation: scenario analysis. This scenario presents a professional challenge stemming from conflicting stakeholder priorities and the inherent tension between efficiency and thoroughness in claims auditing. The reinsurer faces pressure to expedite claims settlements to maintain positive relationships with cedents and manage operational costs. However, a rushed or superficial review risks overlooking material misrepresentations, errors in calculation, or noncompliance with policy terms, which could lead to financial losses for the reinsurer and potential regulatory scrutiny. The need for a robust claims auditing process that balances speed with accuracy and adherence to regulatory requirements is paramount. Correct approach analysis. The correct approach involves a systematic, risk-based review of claims, prioritizing those with higher potential for error or dispute. This method acknowledges that not all claims require the same level of scrutiny. By focusing resources on complex or high-value claims, the reinsurer can ensure that critical aspects are thoroughly examined while still achieving a reasonable pace for simpler claims. This aligns with regulatory expectations for prudent risk management and sound financial practices. Specifically, it supports the principles of ensuring the accuracy of financial reporting and maintaining adequate controls over claims liabilities, as often mandated by insurance regulators to protect policyholders and the financial stability of the insurance market. This approach demonstrates due diligence and a commitment to fair claims handling. Incorrect approach is analysis. Adopting a blanket policy of immediate payment for all claims, regardless of complexity or value, represents a significant regulatory and ethical failure. This approach prioritizes speed over accuracy and due diligence, potentially leading to the payment of fraudulent or erroneous claims. It fails to uphold the reinsurer's responsibility to manage its financial obligations prudently, and could be viewed as a dereliction of duty by regulators, potentially resulting in fines or sanctions for inadequate internal controls. Implementing a policy of delaying all claims payments until a comprehensive, in-depth audit of every single claim is completed, irrespective of its size or complexity, is also professionally unacceptable. While thoroughness is important, this approach is operationally inefficient and can severely damage cedent relationships. It also fails to recognize the principle of proportionality in auditing, where the effort expended should be commensurate with the risk. Such an approach could be seen as a failure to act with reasonable promptness in claims handling, which is often a regulatory requirement and a breach of good faith. Focusing solely on the volume of claims processed without regard to the accuracy or validity of those claims is another flawed strategy. This metric-driven approach can incentivize superficial reviews and a disregard for the underlying details of the claims. It prioritizes a quantitative output over the qualitative assurance of correct claim adjudication, exposing the reinsurer to financial risk and potentially violating regulatory mandates concerning the integrity of claims handling and financial reporting. Professional reasoning. Professionals should adopt a risk-based approach to claims auditing. This involves developing clear criteria for claim review intensity based on factors such as claim value, complexity, historical patterns of error with specific cedents, and potential for fraud. Regular training for claims auditors on policy terms, regulatory requirements, and fraud detection techniques is essential. Furthermore, establishing clear communication channels with cedents to address queries and facilitate information exchange can improve efficiency without compromising thoroughness. A robust internal control framework, including regular internal audits of the claims auditing process itself, is crucial for continuous improvement and regulatory compliance. Question 3. The review process indicates that a ceding insurer is seeking to take credit for reinsurance on a significant portfolio of business. The reinsurance agreement has been executed, and the reinsurer is a reputable entity with a long history in the market. However, a closer examination of the agreement reveals that, while it broadly covers the same risks as the underlying policies, certain clauses introduce a degree of ambiguity regarding the reinsurer's ultimate liability in specific, albeit infrequent, scenarios. The underwriter is considering approving the credit for reinsurance, relying on the reinsurer's reputation and the general alignment of the agreement with the underlying business. Which of the following approaches best aligns with the regulatory framework for granting credit for reinsurance? Option A. Approve the credit for reinsurance immediately, assuming that any disputes arising from ambiguous clauses would be resolved through standard legal arbitration processes, which are implicitly covered by the existence of a contract. Option B. Approve the credit for reinsurance, but reduce the amount of credit taken to account for the potential impact of the ambiguous clauses without seeking to amend the agreement. Option C. Approve the credit for reinsurance, as the reinsurer is reputable and the agreement generally covers the underlying risks, with the ambiguous clauses considered minor and unlikely to impact significant claims. Option D. Defer approval of the credit for reinsurance until the ambiguous clauses in the agreement are clarified and amended to ensure a clear and unequivocal transfer of risk, in line with regulatory expectations for solvency and financial stability. The correct answer is C. Approve the credit for reinsurance, as the reinsurer is reputable and the agreement generally covers the underlying risks, with the ambiguous clauses considered minor and unlikely to impact significant claims. Explanation. The review process indicates a common challenge in reinsurance applications, ensuring that the credit taken for reinsurance is fully supported by the underlying agreements and regulatory requirements. This scenario is professionally challenging because it requires a nuanced understanding of the specific regulations governing credit for reinsurance, not just a superficial check. The underwriter must exercise careful judgment to balance the company's financial objectives with its regulatory obligations and the principles of sound risk management. The correct approach involves a thorough examination of the reinsurance agreement to confirm that it meets all the specified requirements for granting credit. This includes verifying that the reinsurer is solvent and possesses the necessary financial strength, that the terms of the agreement align with the underlying policies being reinsured, and that appropriate documentation is in place. Specifically, under UK regulations, this would involve ensuring compliance with the PRA rulebook, particularly Solvency Roman II requirements relating to credit for reinsurance, which mandate that the reinsurer must be authorized and regulated in a recognized jurisdiction or meet specific financial strength criteria. The agreement must also clearly define the scope of coverage and the reinsurer's obligations, preventing any ambiguity that could jeopardize the credit taken. An incorrect approach would be to grant credit for reinsurance based solely on the existence of a reinsurance contract, without verifying the reinsurer's financial stability. This fails to meet the regulatory requirement for a solvent reinsurer and exposes the ceding company to undue risk if the reinsurer cannot meet its obligations. Another incorrect approach is to assume that any contract labeled reinsurance automatically qualifies for credit. This overlooks the specific conditions stipulated by regulators, such as the need for the reinsurance to cover a genuine risk transfer and not be a mere financial arrangement. Furthermore, accepting a reinsurance agreement that does not adequately mirror the terms and conditions of the underlying policies, or that contains clauses that could limit the reinsurer's liability in a way that undermines the intended risk transfer, would also be an incorrect approach. This could lead to a situation where the ceding company is unable to recover claims from the reinsurer, despite having taken credit for the reinsurance. Professionals should adopt a decision-making framework that prioritizes regulatory compliance and robust risk assessment. This involves 1. Understanding the specific regulatory framework applicable to credit for reinsurance in the relevant jurisdiction, in this case, UK regulations. 2. Conducting due diligence on the reinsurer, including assessing its financial strength and regulatory status. 3. Scrutinizing the reinsurance agreement to ensure it meets all stipulated requirements for risk transfer and coverage. 4. Documenting the assessment and decision-making process thoroughly. 5. Seeking expert advice when in doubt. Question 4. Operational review demonstrates that a potential cedent has a history of significant operational control deficiencies, which they claim to have rectified through a comprehensive remediation program. The cedent has provided documentation outlining their new processes and controls. What is the most appropriate approach for the reinsurer to take in assessing this application? Option A. Accept the cedent's documentation at face value and proceed with underwriting, assuming the remediation efforts have been successful given the cedent's assurances. Option B. Decline the reinsurance application outright due to the cedent's historical operational deficiencies, regardless of their claimed remediation efforts. Option C. Conduct an independent audit of the cedent's new operational processes and controls, and seek evidence of their effectiveness over a defined period before making a decision on the reinsurance application. Option D. Request a higher premium to compensate for the perceived residual risk associated with the cedent's past operational issues, without further independent verification of their remediation. The correct answer is C. Conduct an independent audit of the cedent's new operational processes and controls, and seek evidence of their effectiveness over a defined period before making a decision on the reinsurance application. Explanation. This scenario is professionally challenging because it requires a reinsurer to balance the need for efficient underwriting with the imperative of robust risk assessment and due diligence, particularly when dealing with a cedent that has a history of operational issues. The pressure to secure new business can create a temptation to overlook or downplay identified weaknesses. However, regulatory frameworks, such as those governing the insurance and reinsurance industry, mandate a thorough understanding of the risks associated with any proposed reinsurance arrangement. Failure to conduct adequate due diligence can expose the reinsurer to unforeseen losses, reputational damage, and regulatory sanctions. The correct approach involves a comprehensive review of the cedent's operational capabilities and financial stability, with a specific focus on addressing the previously identified issues. This includes verifying that the cedent has implemented effective remediation plans, and that these plans are demonstrably reducing the likelihood of future operational failures. Regulatory requirements, such as those found in solvency regulations and conduct of business rules, emphasize the importance of prudent risk management and ensuring that a reinsurer has a clear understanding of the risks it is assuming. This approach aligns with the principle of know your counterparty and ensures that the reinsurance contract is underwritten on a sound basis, reflecting the true risk profile. An incorrect approach would be to proceed with the reinsurance application without independently verifying the cedent's remediation efforts. This demonstrates a failure to conduct adequate due diligence, potentially violating regulatory expectations for prudent underwriting and risk management. It suggests a reliance on the cedent's self-assessment without independent corroboration, which is insufficient when past operational issues have been identified. Another incorrect approach would be to accept the cedent's assurances at face value and proceed with underwriting based solely on the cedent's representations, especially if those representations are not supported by objective evidence or independent verification. This bypasses the critical step of risk assessment and due diligence, exposing the reinsurer to significant unquantified risks and potentially breaching regulatory requirements for a thorough understanding of the business being reinsured. Professionals should adopt a structured decision-making process that prioritizes risk assessment and due diligence. This involves 1. Identifying and understanding the specific risks presented by the cedent, including historical operational weaknesses. 2. Developing a clear plan for due diligence, outlining the information required to assess the effectiveness of remediation efforts. 3. Gathering and independently verifying relevant information, such as audit reports, internal control documentation, and evidence of process improvements. 4. Evaluating the findings of the due diligence against the reinsurer's risk appetite and underwriting standards. 5. Making a well-informed decision based on the comprehensive risk assessment, which may include accepting the risk with appropriate pricing and terms, requesting further information, or declining the business if the risks are deemed unacceptable. Question 5. Assessment of the adequacy of a reinsurer's economic capital model for a proposed quota share reinsurance treaty considering the model's ability to capture the specific risk profile of the reinsured portfolio and its alignment with regulatory solvency requirements. Option A. Focus solely on the potential for diversification benefits within the reinsurer's existing portfolio, assuming the new reinsurance business will not significantly alter the overall risk aggregation. Option B. Conduct a comprehensive review of the economic capital model's assumptions, methodologies, and outputs, stress testing its performance against scenarios relevant to the reinsured portfolio and the reinsurance treaty, and validating its capital allocation against regulatory solvency standards. Option C. Accept the ceding insurer's economic capital model as sufficient, assuming it has been approved by their primary regulator, and apply a standard capital uplift based on the treaty's premium volume. Option D. Utilize a simplified capital calculation based on a fixed percentage of the gross risk ceded, without performing detailed model validation or stress testing, as long as it meets the minimum regulatory capital thresholds. The correct answer is B. Conduct a comprehensive review of the economic capital model's assumptions, methodologies, and outputs, stress testing its performance against scenarios relevant to the reinsured portfolio and the reinsurance treaty, and validating its capital allocation against regulatory solvency standards. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a reinsurer to evaluate the adequacy of its economic capital model in the context of a significant reinsurance transaction. The challenge lies in ensuring that the model accurately reflects the risks being transferred and retained, and that the capital held is sufficient to meet regulatory solvency requirements and policyholder obligations under stressed conditions. Misjudging the model's effectiveness could lead to undercapitalization, regulatory sanctions, and reputational damage. The complexity arises from the interplay between the specific terms of the reinsurance treaty, the underlying risks of the ceding insurer, and the reinsurer's own risk appetite and capital management strategy. Correct approach analysis. The correct approach involves a comprehensive review of the economic capital model's assumptions, methodologies, and outputs specifically in relation to the proposed reinsurance transaction. This includes stress testing the model under various adverse scenarios relevant to the reinsured portfolio, and assessing whether the model's capital allocation adequately covers the incremental risk introduced by the treaty. Regulatory justification stems from the principle that insurers must hold sufficient capital to absorb unexpected losses and remain solvent. For example, under the UK's Solvency Roman II framework, firms are required to calculate and maintain a solvency capital requirement, SCR, that reflects the overall solvency needs of the business. An economic capital model, when used appropriately, should inform this SCR. Best practice dictates that the model should be validated against historical data, peer benchmarks, and expert judgment, and its limitations clearly understood and documented. The model's ability to capture the specific risk profile of the reinsurance treaty, including any aggregation benefits or concentration risks, is paramount. Incorrect approach is analysis. Relying solely on the ceding insurer's existing economic capital model without independent validation or adjustment is an incorrect approach. This fails to acknowledge that the reinsurer has its own risk profile and capital requirements, and the ceding insurer's model may not be calibrated to the reinsurer's specific risk appetite or regulatory jurisdiction. This could lead to an underestimation of the capital required by the reinsurer. Using a simplified, rule-of-thumb capital allocation based on premium volume or a fixed percentage of the gross risk without a robust modeling framework is also incorrect. This approach ignores the nuanced risk characteristics of the underlying business and the specific terms of the reinsurance contract, potentially leading to inadequate capital provisioning. Regulatory frameworks, such as Solvency Roman II, emphasize risk-based capital, meaning capital requirements should be proportional to the actual risks undertaken. Ignoring the potential for correlation or aggregation of risks between the reinsurer's existing portfolio and the newly reinsured business is another incorrect approach. Economic capital models are designed to capture these interactions. Failing to do so can lead to an inaccurate assessment of the overall risk profile and capital needs, potentially violating the principle of holding capital commensurate with the total risk exposure. Professional reasoning. Professionals should adopt a systematic approach to evaluating economic capital models in the context of reinsurance. This involves 1. 1. Understanding the specific risks associated with the reinsurance treaty and the underlying portfolio. 2. Critically assessing the appropriateness and robustness of the economic capital model, including its assumptions, data inputs, and methodologies. 3. Performing independent validation and stress testing of the model, particularly concerning the impact of the reinsurance transaction. 4. Ensuring that the model's outputs are used to inform the reinsurer's overall capital management strategy and regulatory capital requirements. 5. Documenting all assumptions, analyses, and decisions thoroughly. Question 6. Upon reviewing a catastrophe model's output for a proposed reinsurance treaty covering a coastal region prone to hurricanes, what is the most prudent approach for the reinsurer's underwriting team to ensure regulatory compliance and sound risk assessment, considering the model's inherent limitations? Option A. Focus solely on the model's geographical resolution and peril coverage, assuming that if these aspects appear adequate, the output figures can be trusted without further scrutiny of data or assumptions. Option B. Accept the model's primary output figures for expected losses and probable maximum losses as definitive indicators of risk, and proceed with pricing and terms based solely on these figures. Option C. Conduct a detailed review of the model's input data quality, underlying assumptions, and the sensitivity of its outputs to variations in these factors, and then use this understanding to inform underwriting decisions and treaty terms. Option D. Disregard the catastrophe model's output entirely, citing concerns about its general reliability, and rely exclusively on historical loss data and anecdotal evidence for underwriting decisions. The correct answer is C. Conduct a detailed review of the model's input data quality, underlying assumptions, and the sensitivity of its outputs to variations in these factors, and then use this understanding to inform underwriting decisions and treaty terms. Explanation. This scenario is professionally challenging because it requires a reinsurer to critically evaluate the outputs of a catastrophe model, not just accept them at face value. The challenge lies in understanding the inherent limitations of these models and ensuring that the underwriting decisions based on their outputs are sound, compliant, and reflect a true understanding of the risk. It requires a balance between leveraging sophisticated tools and applying seasoned professional judgment. The correct approach involves a thorough review of the catastrophe model's inputs and outputs, specifically scrutinizing the underlying assumptions and data quality. This is crucial because regulatory frameworks, such as those governing insurance and reinsurance in the UK e.g., PRA Rulebook, FCA Handbook, emphasize the need for firms to have robust risk management systems and to understand the risks they are underwriting. Accepting model outputs without due diligence could lead to mispricing of risk, inadequate capital allocation, and ultimately, regulatory breaches if it results in the firm taking on risks it cannot manage or support. A deep understanding of the model's limitations, such as its sensitivity to input data, the scope of perils modeled, and the geographical resolution, is essential for making informed decisions about treaty terms, pricing, and capital requirements, thereby ensuring compliance with solvency and risk management expectations. An incorrect approach would be to solely rely on the catastrophe model's headline figures without questioning the underlying data or assumptions. This fails to meet the regulatory expectation of a deep understanding of risk. For instance, if the model uses outdated or incomplete historical loss data for a specific region, its output might significantly underestimate the potential losses from a future event. Accepting this without critical review would be a failure to exercise due diligence, potentially leading to underpricing and insufficient reserves, which could contravene prudential requirements. Another incorrect approach would be to dismiss the catastrophe model's outputs entirely due to a general distrust of such tools, without undertaking a structured review to identify specific areas of concern or potential inaccuracies. While skepticism is healthy, a complete disregard for a widely accepted risk assessment tool, without a reasoned basis for doing so, could be seen as a failure to employ appropriate risk management techniques. Regulators expect firms to utilize available tools and methodologies to assess risk, and a blanket rejection without a valid, documented reason would be professionally unsound and potentially non-compliant with the expectation to manage risks effectively. The professional decision-making process should involve 1. Understanding the purpose and scope of the catastrophe model being used. 2. Critically evaluating the quality and relevance of the input data. 3. Assessing the model's assumptions and their appropriateness for the specific risk being underwritten. 4. analyzing the model's outputs in conjunction with other risk assessment methods and expert judgment. 5. Documenting the review process, including any limitations identified and how they were addressed in the decision-making. 6. Ensuring that the final underwriting decision is supported by a comprehensive understanding of the risk, not just the model's output. Question 7. The assessment process reveals that a potential cedent has submitted a reinsurance application with some data points that appear inconsistent with industry benchmarks for similar business lines. The underwriting team is under pressure to finalize the placement within a tight deadline. Which of the following approaches best aligns with regulatory requirements and professional best practices for handling this situation? Option A. Request detailed explanations and supporting documentation from the cedent to clarify the discrepancies and delay final underwriting decisions until satisfactory information is obtained. Option B. Accept the cedent's provided data as presented, assuming the cedent has conducted their own due diligence and has valid reasons for the figures. Option C. Focus on the positive aspects of the application and downplay the significance of the data inconsistencies to facilitate a quicker decision. Option D. Proceed with the application by making reasonable assumptions to bridge the data gaps, prioritizing the timely placement of the reinsurance treaty. The correct answer is D. Proceed with the application by making reasonable assumptions to bridge the data gaps, prioritizing the timely placement of the reinsurance treaty. Explanation. The assessment process reveals a common implementation challenge in reinsurance applications, ensuring that the information provided by the cedent accurately reflects the underlying risks and that the reinsurer's underwriting assumptions are met. This scenario is professionally challenging because it requires a nuanced understanding of both the cedent's business and the reinsurer's risk appetite, coupled with a commitment to regulatory compliance and ethical disclosure. The pressure to close a deal quickly can sometimes lead to overlooking critical details or making assumptions that are not fully substantiated. Careful judgment is required to balance commercial objectives with the imperative of sound underwriting and regulatory adherence. The correct approach involves a thorough and documented review of the cedent's application, including all supporting documentation, to verify the accuracy and completeness of the information provided. This includes cross-referencing data, seeking clarification on any ambiguities, and ensuring that the proposed reinsurance terms align with the cedent's actual risk profile and the reinsurer's underwriting guidelines. This approach is professionally sound because it upholds the principles of utmost good faith, a cornerstone of reinsurance contracts. It ensures that the reinsurer is making an informed decision based on a true and fair representation of the risk, thereby preventing adverse selection and potential future disputes. Regulatory frameworks, such as those governing insurance and reinsurance, mandate that all parties act with transparency and provide accurate information. An incorrect approach that involves accepting the cedent's representations at face value without independent verification or due diligence fails to uphold the principle of utmost good faith. This can lead to the reinsurer assuming risks that are not adequately understood or priced, potentially resulting in financial losses and regulatory scrutiny for failing to conduct proper underwriting. Another incorrect approach, which is to proceed with the application based on assumptions about the cedent's business practices without explicit confirmation, is also professionally unacceptable. This introduces a significant element of uncertainty and can be construed as a lack of diligence. It deviates from the regulatory expectation that underwriting decisions are based on concrete evidence and a clear understanding of the risks involved. A further incorrect approach, such as selectively focusing on information that supports the desired outcome while downplaying or ignoring potentially adverse details, represents a serious ethical and regulatory breach. This undermines the integrity of the underwriting process and can lead to misrepresentation of the risk to the reinsurer's own management and stakeholders, as well as potential violations of disclosure requirements. The professional reasoning process for similar situations should involve a structured due diligence framework. This includes clearly defining the information required from the cedent, establishing internal review protocols, and documenting all steps taken during the assessment. When faced with incomplete or ambiguous information, the professional should proactively seek clarification and escalate concerns internally if necessary. The decision-making process must prioritize regulatory compliance, ethical conduct, and sound risk management over expediency. Question 8. Performance analysis shows that Accredited has a strong track record of effective claims management and a consistently lower than average loss ratio for the type of business being reinsured. The reinsurer is considering pricing a proportional reinsurance treaty and needs to select the most appropriate method that reflects this Accredited's superior performance while remaining compliant with regulatory expectations for fair and risk-reflective pricing. Option A. Employ a fixed percentage of the Accredited's gross premium, irrespective of their loss history or expected future claims. Option B. Utilize the burning cost method, adjusting the historical loss data for anticipated future trends and the Accredited's specific risk management practices. Option C. Base the pricing solely on the reinsurer's overall profitability targets with minimal consideration for the Accredited's specific risk profile. Option D. Apply a standard industry loss ratio method based on broad market averages, without significant adjustments for the Accredited's unique experience. The correct answer is B. Utilize the burning cost method, adjusting the historical loss data for anticipated future trends and the Accredited's specific risk management practices. Explanation. This scenario presents a professional challenge because the reinsurer must select a pricing method for proportional reinsurance that accurately reflects the risk, while adhering to regulatory expectations for transparency and fairness. The challenge lies in balancing the need for a robust pricing model with the practicalities of data availability and the potential for misinterpretation of complex methodologies by the Accredited. Careful judgment is required to ensure the chosen method is both technically sound and communicable. The correct approach involves using the burning cost method. This method is considered best professional practice because it directly links the reinsurance premium to the Accredited's historical loss experience, adjusted for expected future trends. This aligns with regulatory principles that encourage pricing to be reflective of the underlying risk. Specifically, in the context of the reinsurance applications exam, regulators expect pricing to be justifiable and not arbitrary. The burning cost method provides this justification by demonstrating a clear relationship between the Accredited's claims and the cost of reinsurance. It promotes a fair and equitable premium, as the Accredited is charged based on its own performance, encouraging better risk management. An incorrect approach would be to solely rely on the loss ratio method without significant adjustments for the Accredited's specific experience. While the loss ratio method uses industry averages, it can lead to an inaccurate premium if the Accredited's loss experience deviates significantly from the norm. This could result in the Accredited overpaying for coverage if their losses are lower than average, or the reinsurer underpricing the risk if the Accredited's losses are higher than average. This lack of specific risk reflection could be viewed by regulators as potentially unfair or not adequately risk commensurate, potentially leading to disputes and regulatory scrutiny. Another incorrect approach would be to use a simplified, fixed percentage of gross premium without any consideration for the Accredited's loss history or expected future losses. This method is overly simplistic and fails to account for the inherent variability and specific risk profile of the Accredited. Regulators would likely view this as an arbitrary pricing mechanism that does not adequately reflect the risk being transferred, potentially leading to adverse selection or an unsustainable pricing structure. It lacks the analytical rigor expected in reinsurance pricing. The professional decision-making process for similar situations should involve a thorough understanding of the available data, the specific risks underwritten by the Accredited, and the regulatory expectations for pricing. Professionals should prioritize methods that offer transparency, are justifiable based on risk, and promote a fair relationship between the Accredited and reinsurer. This involves evaluating the strengths and weaknesses of different pricing methodologies in the context of the specific transaction and the applicable regulatory framework, ensuring that the chosen method is both commercially viable and ethically sound. Question 9. Implementation of a new automated system for processing non-proportional reinsurance applications, designed to reduce manual data entry and speed up initial assessments, requires careful consideration of regulatory compliance. Which of the following approaches best ensures adherence to the FCA's regulatory framework for reinsurance applications? Option A. Prioritize the speed of application processing by allowing the IT department to finalize the system without extensive input from compliance or legal, as long as the system appears functional. Option B. Conduct a comprehensive review of the automated system's data handling and output by the compliance and legal departments, verifying its accuracy against policy terms and regulatory reporting requirements before full deployment, and ensuring no essential information is omitted or misrepresented. Option C. Deploy the automated system immediately after initial internal testing, assuming it accurately captures and processes data based on common reinsurance principles, with a plan to address any regulatory issues that arise post-implementation. Option D. Implement the automated system with a reduced set of data fields to simplify processing, relying on the cedent to provide any missing information during the claims stage. The correct answer is C. Deploy the automated system immediately after initial internal testing, assuming it accurately captures and processes data based on common reinsurance principles, with a plan to address any regulatory issues that arise post-implementation. Explanation. This scenario is professionally challenging because it requires a reinsurer to balance the efficiency gains of process optimization with the absolute priority of adhering to regulatory requirements for non-proportional reinsurance applications. The FCA's principles for businesses, particularly Principle 3, customers' interests, and Principle 6, communicating information in a clear, fair, and not misleading way, are paramount. Furthermore, specific guidance within the FCA handbook, such as ICOB's Insurance Conduct of Business Sourcebook and SUP Supervision Manual, dictates how firms must handle customer information and ensure fair treatment. The core challenge lies in implementing changes that streamline internal operations without compromising the accuracy, completeness, and transparency of information provided to both the cedent and, indirectly, the policyholders. Failure to do so can lead to regulatory sanctions, reputational damage, and a loss of client trust. The correct approach involves a thorough review and validation of the proposed process changes by the compliance and legal departments, ensuring that any automation or streamlining does not alter the fundamental information required for underwriting or claims handling under non-proportional treaties. This includes verifying that automated data extraction accurately reflects the original policy terms and conditions, and that any changes to reporting formats remain compliant with regulatory disclosure standards. This approach upholds regulatory obligations by ensuring that the integrity of the reinsurance application process is maintained, customer interests are protected through accurate information handling, and clear communication is preserved. An incorrect approach that prioritizes speed over regulatory scrutiny would involve immediately deploying automated systems without comprehensive validation. This risks introducing errors in data capture or misinterpreting policy details, which could lead to incorrect premium calculations, inadequate reserves, or disputes during claims. Such an approach would violate FCA principles by potentially harming customer interests and failing to communicate information fairly and clearly. Another incorrect approach would be to implement changes that reduce the level of detail in the information submitted to the cedent, even if it simplifies internal processing. This could contravene regulatory expectations for transparency and completeness in reinsurance arrangements, potentially leading to misunderstandings about coverage or obligations. Finally, an approach that bypasses the compliance department's review of the automated system's output would be professionally unacceptable. This ignores the critical oversight function, designed to ensure adherence to regulatory frameworks and ethical standards, exposing the firm to significant compliance risks. Professionals should adopt a decision-making framework that begins with identifying the regulatory implications of any proposed process change. This involves consulting relevant FCA handbook sections and seeking expert advice from compliance and legal teams. The next step is to assess the impact on customer interests and the clarity of communication. Only after a thorough risk assessment and validation process, ensuring full compliance, should any process optimization be implemented. Question 10. Which approach would be most aligned with the regulatory framework's definition and purpose of reinsurance when assessing its impact on an insurer's operations? Option A. Diversifying the primary insurer's investment portfolio through reinsurance transactions. Option B. Enhancing administrative efficiency by outsourcing claims handling to a reinsurer. Option C. Strengthening the primary insurer's financial stability and capacity to underwrite new business. Option D. Reducing the primary insurer's immediate capital requirements through risk transfer. The correct answer is C. Strengthening the primary insurer's financial stability and capacity to underwrite new business. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of reinsurance's fundamental purpose beyond mere risk transfer. The challenge lies in identifying the approach that best reflects the core regulatory intent behind allowing and overseeing reinsurance, which is to ensure the solvency and stability of the primary insurer, thereby protecting policyholders. A superficial understanding might focus on the mechanics of risk sharing, but a deeper, regulatory-aligned perspective considers the broader impact on the insurer's financial health and its ability to meet its obligations. The correct approach is to focus on how reinsurance strengthens the primary insurer's financial stability and capacity to underwrite new business. This aligns directly with regulatory objectives, as outlined in frameworks like the UK's Solvency Roman II Directive and the FCA's Handbook, which emphasize the importance of insurers maintaining adequate financial resources and managing their risks effectively. Reinsurance, when structured appropriately, allows insurers to absorb larger risks, diversify their exposure, and mitigate the impact of catastrophic events, all of which contribute to their long-term solvency and policyholder protection. This approach directly addresses the why of reinsurance from a supervisory perspective. An incorrect approach that focuses solely on the reduction of the primary insurer's immediate capital requirements, without considering the underlying risk profile or the quality of the reinsurer, fails to grasp the regulatory intent. While capital relief is a consequence of reinsurance, it is not its primary regulatory purpose. Regulators are concerned with the substance of the risk transfer and the insurer's overall financial resilience, not just a cosmetic reduction in capital. This approach risks enabling insurers to offload risks without genuinely improving their financial strength, potentially leaving policyholders vulnerable. Another incorrect approach that prioritizes the diversification of the primary insurer's investment portfolio through reinsurance transactions overlooks the core function of reinsurance. While diversification is a desirable outcome for any financial institution, the primary purpose of reinsurance is to manage underwriting risk, not investment risk. Focusing on investment diversification through reinsurance would be a misapplication of the tool and would not satisfy regulatory expectations regarding risk management for insurance operations. Finally, an approach that emphasizes the administrative efficiency gained by outsourcing claims handling to a reinsurer, while potentially true in some instances, misses the fundamental regulatory purpose of reinsurance. Reinsurance is primarily a risk management tool for underwriting and solvency, not an operational efficiency mechanism for claims processing. Focusing on administrative benefits would be a misinterpretation of the regulatory framework's intent for reinsurance. Professionals should approach such questions by first identifying the core regulatory objective behind the practice in question. In the case of reinsurance, this objective is the financial stability and solvency of the insurer, which ultimately protects policyholders. They should then evaluate each potential approach against this primary objective, considering how it contributes to or detracts from achieving that goal, and whether it aligns with specific regulatory requirements and principles. Question 11. The analysis reveals that a cedent has purchased an aggregate excess of loss reinsurance treaty with a stated attachment point and aggregate limit. The cedent has experienced a series of individual losses throughout the year. Which of the following best describes the critical consideration for determining when the reinsurance coverage will begin to respond to these accumulated losses? Option A. The total sum of all individual losses incurred by the cedent during the treaty period, irrespective of how they are defined or aggregated within the contract. Option B. The total aggregate limit of the reinsurance treaty, as this figure represents the maximum potential payout and therefore the primary indicator of coverage activation. Option C. The precise definition and application of the attachment point as stipulated in the reinsurance contract, which dictates the cedent's retention level before aggregate coverage is triggered. Option D. The occurrence of a single, exceptionally large loss that exceeds a predetermined threshold, regardless of its relation to other losses or the aggregate attachment point. Correct answer is A. The total sum of all individual losses incurred by the cedent during the treaty period, irrespective of how they are defined or aggregated within the contract. Explanation. This scenario presents a professional challenge because it requires a nuanced understanding of how aggregate excess of loss reinsurance operates in practice, specifically concerning the interplay between the attachment point, the limit, and the triggers for coverage. Misinterpreting these elements can lead to significant financial miscalculations for both the cedent and the reinsurer, potentially resulting in underpriced reinsurance, inadequate capital reserves, or disputes over claims handling. The challenge lies in applying the theoretical framework of aggregate excessive loss to a real-world situation where the frequency and severity of losses can fluctuate, impacting when and how the reinsurance protection is activated. Careful judgment is required to ensure the reinsurance contract accurately reflects the cedent's risk appetite and the reinsurer's exposure. The correct approach involves a thorough review of the aggregate excess of loss reinsurance contract, focusing on the precise definition of the attachment point and the aggregate limit. It necessitates understanding how the contract defines loss and the specific events or periods that constitute a loss occurrence for the purpose of aggregating claims. This approach aligns with the regulatory expectation that reinsurance contracts are clearly defined and that both parties understand their obligations and the scope of coverage. Adhering to the contract's terms and conditions, as stipulated by relevant insurance and reinsurance regulations, e.g., those governing solvency, fair dealing, and contract interpretation, ensures that the reinsurance protection functions as intended, providing the agreed-upon financial backstop against accumulated losses exceeding a specified threshold. This also upholds the principle of utmost good faith, ensuring transparency and accuracy in reporting and claims handling. An incorrect approach would be to assume that all losses occurring within a policy year will automatically aggregate towards the attachment point, regardless of their nature or the specific wording of the contract. This fails to account for potential exclusions or specific aggregation rules outlined in the policy, which could lead to a miscalculation of the actual exposure. This approach risks violating regulatory requirements related to accurate financial reporting and solvency, as it may result in an underestimation of the cedent's net retained risk and an overestimation of the reinsurer's liability. Another incorrect approach would be to focus solely on the aggregate limit, without a clear understanding of the attachment point. This can lead to a situation where the cedent believes they have comprehensive coverage, only to find that a significant portion of losses falls below the attachment point and is therefore not covered by the reinsurance. This demonstrates a failure to grasp the fundamental structure of excess of loss reinsurance, where coverage only applies once a certain retention level, the attachment point, is breached. This can lead to regulatory scrutiny regarding the adequacy of the cedent's risk management practices and potentially result in penalties for failing to maintain appropriate levels of insurance or reinsurance. A third incorrect approach would be to interpret coverage triggers in a manner that is inconsistent with the contract's definitions. For instance, assuming that any single large loss, even if it doesn't meet the criteria for an occurrence as defined in the policy, will immediately contribute to the aggregate attachment point. This misunderstands the purpose of aggregate excessive loss, which is designed to protect against the accumulation of losses over a period, not necessarily individual catastrophic events that might be covered under different reinsurance structures. This misinterpretation can lead to disputes and a failure to comply with the spirit and letter of the reinsurance agreement, potentially exposing the cedent to unforeseen financial burdens and regulatory noncompliance. The professional reasoning process for navigating such situations should involve a meticulous review of the reinsurance contract, paying close attention to definitions, attachment points, limits, and any specific clauses related to loss aggregation and coverage triggers. It requires seeking clarification from legal counsel or experienced reinsurance professionals when ambiguities arise. Professionals must prioritize adherence to regulatory frameworks that mandate clear contract terms, accurate financial reporting, and fair dealing with all parties. The decision-making process should always be guided by the principle of ensuring that the reinsurance arrangement provides the intended protection, and that all parties have a mutual and accurate understanding of their respective rights and obligations. Question 12. The risk matrix shows a significant increase in the likelihood of large-scale cargo theft for a specific shipping route. The cedent has already initiated its own recovery efforts, including engaging with local authorities and private investigators, and has informed the reinsurer of these actions. The reinsurer, reviewing the cedent's preliminary report, believes there may be further avenues for recovery that the cedent has not yet explored. What is the most appropriate course of action for the reinsurer regarding salvage and subrogation rights? Option A. Demand that the cedent immediately cease all recovery efforts and transfer the entire salvage and subrogation process to the reinsurer to ensure maximum recovery. Option B. Proactively engage with the cedent to understand their ongoing recovery efforts. Share insights on potential additional avenues for recovery based on the reinsurer's expertise, and collaboratively determine the most effective strategy for pursuing salvage and subrogation, respecting the cedent's primary role in claim management. Option C. Waive all rights to salvage and subrogation, as the cedent has already commenced its own recovery action, to avoid any potential conflict or duplication of efforts. Option D. Immediately initiate independent legal proceedings against potential third-party perpetrators identified in the cedent's preliminary report, without further consultation with the cedent. The correct answer is D. Immediately initiate independent legal proceedings against potential third-party perpetrators identified in the cedent's preliminary report, without further consultation with the cedent. Explanation: this scenario is professionally challenging because it requires the reinsurer to balance its contractual rights and obligations with the potential impact on the cedent's business relationships and the overall integrity of the reinsurance market. The core tension lies in the reinsurer's right to pursue salvage and subrogation versus the practical and ethical considerations of how these rights are exercised, particularly when the cedent has already taken steps to mitigate losses. Careful judgment is required to ensure that the pursuit of these rights is both legally sound and commercially prudent, avoiding actions that could damage long-term partnerships or create adverse precedents. The correct approach involves a thorough investigation of the cedent's actions and the circumstances surrounding the loss to determine if the cedent has acted reasonably and diligently in mitigating damages and pursuing recoveries. This approach prioritizes understanding the cedent's efforts and assessing whether the reinsurer's intervention would genuinely enhance recovery or merely duplicate efforts, potentially at the cedent's expense or to the detriment of their relationships. Regulatory frameworks, such as those governing insurance and reinsurance in the UK, emphasize good faith and fair dealing between parties. Exercising salvage and subrogation rights must be done in a manner consistent with these principles, respecting the cedent's primary role in managing the claim and recovery process. The reinsurer should seek to cooperate with the cedent, offering support or expertise where beneficial, rather than unilaterally asserting rights in a way that undermines the cedent's position or creates unnecessary conflict. This aligns with the principles of fair treatment of customers and maintaining market confidence, which are implicit in the regulatory oversight of the insurance sector. An incorrect approach would be to immediately and aggressively pursue salvage and subrogation rights without fully investigating the cedent's existing recovery efforts. This demonstrates a lack of understanding of the cedent's operational context and a failure to act in good faith. Such an approach could lead to the reinsurer pursuing claims that the cedent has already resolved or is in the process of resolving, potentially creating legal complications and damaging the business relationship. It also risks overlooking the cedent's own expertise and established recovery channels. Another incorrect approach is to waive all salvage and subrogation rights simply because the cedent has already taken some action. While cooperation is key, a blanket waiver without proper assessment could mean the reinsurer forfeits legitimate recovery opportunities that the cedent may not have been able to fully exploit. This would be a failure to act prudently in managing the reinsurer's financial exposure and could be seen as a dereliction of duty to the reinsurer's own stakeholders. A third incorrect approach involves initiating legal action against third parties without consulting or involving the cedent. This not only disregards the cedent's existing relationships and potential conflicts, but also violates the principle of acting collaboratively. In many jurisdictions, the reinsurer's right to subrogate is often exercised in the name of the cedent, requiring their cooperation and consent. Unilateral action can jeopardize the claim and create significant legal and reputational risks. The professional decision-making process for similar situations should involve a structured assessment. First, thoroughly review the reinsurance contract to understand the specific terms regarding salvage and subrogation. Second, engage in open and transparent communication with the cedent to understand their loss mitigation and recovery efforts to date. Third, conduct an independent assessment of the loss and potential recovery avenues, considering the cedent's actions. Fourth, determine the most effective and collaborative strategy for pursuing salvage and subrogation, prioritizing mutual benefit and adherence to regulatory principles of good faith and fair dealing. If pursuing recovery, ensure all actions are taken with the cedent's knowledge and, where appropriate, consent, and in a manner that upholds the integrity of the reinsurance relationship and the market. Question 13. The audit findings indicate that several claims reported to reinsurers by the company's underwriting department were submitted with incomplete supporting documentation, and some reports were delayed beyond the stipulated timelines outlined in the company's reinsurance treaties and relevant regulatory guidelines. Which of the following represents the most appropriate immediate course of action for the company's compliance officer? Option A. Initiate a comprehensive review of all recent claims reports against the specific regulatory framework and reinsurance treaty requirements to identify the extent of the noncompliance and implement targeted corrective actions. Option B. Classify the audit findings as minor administrative errors and instruct the underwriting team to be more diligent in the future, without undertaking a formal investigation or implementing systemic changes. Option C. Advise the underwriting department to expedite future claims reporting and documentation to avoid further delays, assuming the current instances are isolated incidents. Option D. Request an extension from the reinsurers to submit the missing documentation, focusing solely on rectifying the immediate reporting gaps without a broader process review. Correct answer is A. Initiate a comprehensive review of all recent claims reports against the specific regulatory framework and reinsurance treaty requirements to identify the extent of the noncompliance and implement targeted corrective actions. Explanation. The audit findings indicate a potential systemic issue in how the reinsurance company handles claims reporting and documentation, which is a critical area for regulatory compliance and operational integrity. This scenario is professionally challenging because it requires a nuanced understanding of the specific regulatory framework governing reinsurance applications, particularly concerning the timeliness and completeness of claims information. The pressure to maintain strong relationships with cedents and avoid disputes can sometimes lead to overlooking minor documentation deficiencies. But regulatory adherence must be paramount. Careful judgment is required to balance operational efficiency with the absolute necessity of meeting all reporting and documentation mandates. The correct approach involves immediately initiating a thorough review of the identified audit findings, cross-referencing them against the specific requirements of the reinsurance applications exams governing regulatory framework. This means meticulously examining the nature of the deficiencies, determining if they constitute breaches of reporting timelines, insufficient detail, or missing essential documents as stipulated by the regulations. The subsequent action must be to implement corrective measures that not only address the immediate findings, but also strengthen internal processes to prevent recurrence. This includes updating internal procedures, providing targeted training to relevant staff, and establishing robust quality control checks. This approach is correct because it directly confronts the identified issues with a commitment to regulatory compliance, demonstrating due diligence and a proactive stance in risk management. It aligns with the fundamental principles of regulatory adherence, ensuring that all reporting and documentation obligations are met precisely as required by the governing laws and guidelines for the reinsurance applications exam. An incorrect approach would be to dismiss the audit findings as minor administrative oversights without a formal review. This is professionally unacceptable because it ignores potential regulatory breaches and the associated risks, such as fines, reputational damage, or even license suspension. It fails to uphold the duty of care owed to regulators and stakeholders. Another incorrect approach would be to implement superficial changes, such as simply refiling missing documents without investigating the root cause of the deficiencies. This approach is flawed because it does not address the underlying systemic issues that led to the reporting and documentation failures, making future occurrences highly probable. It demonstrates a lack of commitment to genuine process improvement and regulatory compliance. A further incorrect approach would be to delay corrective actions until a more convenient time or until further regulatory scrutiny arises. This is a significant ethical and regulatory failure. Proactive compliance is a cornerstone of responsible financial operations. Delaying action suggests a disregard for regulatory obligations and can exacerbate the consequences of any identified noncompliance. The professional decision-making process for similar situations should involve a structured approach. 1. Acknowledge and document all audit findings. 2. Immediately consult the specific regulatory framework relevant to the reinsurance applications exam to understand the precise requirements related to the findings. 3. Conduct a root cause analysis of each deficiency. 4. Develop and implement a comprehensive corrective action plan that addresses both the immediate issues and systemic weaknesses. 5. Monitor the effectiveness of the corrective actions and conduct periodic internal reviews to ensure ongoing compliance. 6. Communicate findings and actions taken to relevant internal stakeholders and, if necessary, to regulatory bodies. Question 14. Risk assessment procedures indicate that a cedent may have failed to disclose a known, significant environmental liability associated with a portfolio of commercial property insurance policies when applying for reinsurance coverage. The reinsurer is now considering its options. Which of the following approaches best aligns with the principles of reinsurance contract law and regulatory expectations for handling such a situation? Option A. Conduct a thorough investigation to determine the cedent's knowledge of the liability at the time of application, the potential financial and operational impact of the liability on the underlying risks, and whether this information would have influenced the reinsurer's underwriting decision before making any determination regarding the contract. Option B. Accept the cedent's assurance that the undisclosed environmental liability was not material to the underwriting decision and proceed with the contract as is. Option C. Focus solely on the potential financial cost of the environmental liability and adjust the reinsurance premium retroactively without addressing the underlying disclosure issue. Option D. Immediately declare the reinsurance contract void due to material non-disclosure without further investigation into the cedent's knowledge or the specific impact of the liability. The correct answer is D. Immediately declare the reinsurance contract void due to material non-disclosure without further investigation into the cedent's knowledge or the specific impact of the liability. Explanation. Scenario analysis. This scenario is professionally challenging because it requires the reinsurer to navigate the complexities of reinsurance contract law principles, specifically concerning the duty of utmost good faith, uberrimi fidei, in the context of a material non-disclosure. The reinsurer must assess whether the cedent's failure to disclose a known, significant risk constitutes a breach of this fundamental duty, which could impact the validity and enforceability of the reinsurance contract. This requires a nuanced understanding of what constitutes a material fact and the extent of the disclosure obligation, balancing the cedent's duty with the reinsurer's right to accurate information for underwriting purposes. Correct approach analysis. The correct approach involves a thorough investigation into the nature and materiality of the undisclosed risk. This entails examining the cedent's knowledge at the time of the application, the potential impact of the risk on the underlying insurance portfolio, and whether this information would have influenced the reinsurer's decision to accept the risk or the terms offered. This approach aligns with the principle of utmost good faith, which underpins all reinsurance contracts. Regulatory frameworks, such as those governing insurance and reinsurance in the UK, e.g. the Insurance Act 2015, which codifies aspects of utmost good faith and disclosure, mandate that parties act with honesty and transparency. Failure to investigate a potential breach of this duty would be a dereliction of the reinsurer's responsibility to underwrite risks prudently and in accordance with legal and ethical standards. Incorrect approaches analysis. An approach that immediately seeks to void the contract without a comprehensive investigation into the materiality of the undisclosed risk is procedurally flawed. This bypasses the necessary due diligence and could lead to an unfounded claim of misrepresentation or non-disclosure, potentially violating principles of fairness and good faith if the undisclosed information was not, in fact, material. Another incorrect approach is to accept the cedent's assertion that the undisclosed information was not material without independent verification. This fails to uphold the reinsurer's duty to conduct its own risk assessment and due diligence. It relies solely on the potentially biased perspective of the cedent, undermining the principle of utmost good faith by not independently verifying critical information. Finally, an approach that focuses solely on the financial implications of the undisclosed risk without considering the legal and contractual obligations related to disclosure is incomplete. While financial impact is important, the primary issue is the breach of the duty of utmost good faith, which has legal consequences that may precede or supersede purely financial considerations. Professional reasoning, professionals should adopt a systematic approach when faced with potential non-disclosure. This involves 1. Identifying the alleged non-disclosure and the specific reinsurance contract. 2. Reviewing the reinsurance application and policy wording for disclosure clauses. 3. Investigating the cedent's knowledge and the nature of the undisclosed risk at the time of application. 4. Assessing the materiality of the undisclosed information. Would it have influenced the reinsurer's underwriting decision? 5. Consulting legal counsel if necessary to interpret contractual obligations and relevant laws. 6. Communicating transparently with the cedent regarding the investigation and findings. This structured process ensures compliance with regulatory requirements and ethical obligations, particularly the duty of utmost good faith. Question 15. Strategic planning requires a comprehensive understanding of how reinsurance arrangements affect an insurer's financial reporting. When reviewing a new facultative reinsurance agreement, what is the most appropriate approach to ensure accurate and compliant financial statement disclosures related to its impact? Option A. Analyze the entire reinsurance contract to identify all material financial statement impacts, including changes in reserves, liabilities, and any contingent effects, and disclose these in a manner that is clear, concise, and compliant with all applicable accounting standards and regulatory guidelines. Option B. Focus on disclosing only the gross amounts of premiums and claims to show the full extent of the insurer's business. Option C. Provide a highly technical summary of the reinsurance contract's terms, assuming users have specialized knowledge. Option D. Identify all direct impacts on premiums and claims, and disclose these net amounts clearly. Correct answer is D. Identify all direct impacts on premiums and claims, and disclose these net amounts clearly. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a nuanced understanding of how reinsurance transactions impact a primary insurer's financial statements, specifically concerning the disclosure of financial statement impacts. The challenge lies in balancing the need for transparency with the complexity of reinsurance arrangements, ensuring that stakeholders can accurately assess the insurer's financial health and risk profile without being misled by incomplete or misleading disclosures. The regulatory framework for reinsurance applications exam, which we are strictly adhering to, mandates clear and comprehensive reporting to maintain market integrity and protect policyholders. Correct approach analysis. The correct approach involves a thorough review of the reinsurance contract to identify all financial statement impacts, including changes in premiums, claims, reserves, and any contingent liabilities or benefits. This review must then translate these impacts into disclosures that are clear, concise, and directly address the requirements of the relevant accounting standards and regulatory guidelines for financial statement reporting. Specifically, this means ensuring that the disclosures accurately reflect the economic substance of the reinsurance arrangement and its effect on the insurer's financial position and performance, as required by the principles of fair presentation and transparency. Incorrect approaches analysis. One incorrect approach is to focus solely on the impact on net premiums and claims, neglecting other significant financial statement elements, such as changes in reserves or the potential for contingent liabilities. This failure to capture the full spectrum of financial impacts leads to incomplete and potentially misleading disclosures, violating the regulatory requirement for comprehensive reporting. Another incorrect approach is to provide disclosures that are overly technical or obscure, using jargon that is not readily understood by the intended audience of financial statement users. While accuracy is paramount, the disclosures must also be comprehensible. Failing to present the information in a clear and accessible manner undermines the purpose of financial reporting, which is to inform stakeholders. This contravenes the spirit of regulatory oversight aimed at ensuring informed decision-making by investors and regulators. A third incorrect approach is to disclose only the gross amounts without adequately explaining the offsetting effects of the reinsurance. This can create a distorted view of the insurer's financial standing, overstating its exposures or liabilities. The regulatory framework emphasizes the net effect of transactions, and failing to clearly articulate how reinsurance mitigates or alters these effects is a significant disclosure failure. Professional reasoning. Professionals must adopt a systematic process for analyzing reinsurance contract disclosures. This involves 1. Deeply understanding the specific reinsurance contract terms and conditions. 2. Identifying all potential financial statement impacts, both direct and indirect. 3. Consulting the applicable accounting standards and regulatory pronouncements to determine the precise disclosure requirements. 4. Drafting disclosures that are accurate, complete, transparent, and easily understood by the intended audience. 5. Reviewing disclosures with senior management and compliance officers to ensure adherence to all regulatory and ethical obligations. This structured approach ensures that financial reporting accurately reflects the economic reality of reinsurance transactions. Question 16. Consider a scenario where a cedent requests a working layer excess of loss reinsurance treaty with an attachment point significantly below their historical average loss frequency and a limit that covers a substantial portion of their potential aggregate losses. The reinsurer's underwriting team has reviewed the cedent's submission and identified that the proposed attachment point and limit, if accepted as is, place the reinsurer in a significantly exposed position relative to its stated risk appetite and capital allocation for this class of business. What is the most appropriate course of action for the reinsurer's underwriter? Option A. Negotiate revised terms for the attachment point and limit that better align with the cedent's demonstrated loss experience and the reinsurer's risk appetite, potentially suggesting a higher attachment point and a more proportionate limit, while clearly explaining the rationale to the cedent. Option B. Agree to the cedent's proposed terms but increase the reinsurance premium significantly to compensate for the perceived higher risk without adjusting the attachment point or limit. Option C. Accept the cedent's proposed attachment point and limit to maintain a strong client relationship, assuming the cedent's projections are accurate and the potential for large losses is minimal. Option D. Reject the application outright without further discussion, citing the discrepancy between the cedent's request and the reinsurer's risk appetite, without offering any alternative solutions. The correct answer is A. Negotiate revised terms for the attachment point and limit that better align with the cedent's demonstrated loss experience and the reinsurer's risk appetite, potentially suggesting a higher attachment point and a more proportionate limit, while clearly explaining the rationale to the cedent. Explanation. This scenario presents a professional challenge because it requires the underwriter to balance the cedent's desire for comprehensive coverage with the reinsurer's need to manage its own risk exposure and adhere to its underwriting appetite. The attachment point and limit of a working layer excess of loss treaty are critical parameters that define the scope of the reinsurance protection. Misjudging these can lead to either inadequate coverage for the cedent or excessive exposure for the reinsurer, potentially impacting the financial stability of both parties and violating regulatory principles of prudent risk management. The correct approach involves a thorough analysis of the cedent's historical loss data, underlying exposures, and business strategy to determine an attachment point and limit that are mutually beneficial and financially sound. This means the attachment point should be set at a level where the cedent retains a significant portion of its risk, aligning incentives and encouraging prudent underwriting by the cedent. The limit should be sufficient to protect the cedent from catastrophic losses, but not so high as to create an unmanageable exposure for the reinsurer, considering the reinsurer's capital, reinsurance program, and overall risk appetite. Regulatory compliance is paramount. The proposed terms must align with the reinsurer's approved underwriting guidelines and solvency requirements, ensuring the reinsurer can meet its obligations to the cedent and its policyholders. This approach demonstrates a commitment to sound underwriting principles and regulatory adherence. An incorrect approach would be to simply accept the cedent's requested attachment point and limit without independent verification or analysis. This fails to uphold the reinsurer's fiduciary duty to its shareholders and policyholders by potentially exposing the reinsurer to risks it has not adequately assessed or priced for. It also risks violating regulatory requirements that mandate prudent underwriting and risk management. Another incorrect approach would be to set an attachment point that is too high or a limit that is too low, solely to minimize the reinsurer's immediate premium outflow or perceived exposure. This would fail to provide adequate protection to the cedent, potentially leaving them underinsured against significant losses. This could lead to regulatory scrutiny for the cedent and damage the professional relationship, as the reinsurance coverage would not fulfill its intended purpose. A third incorrect approach would be to agree to terms that exceed the reinsurer's established underwriting authority or risk appetite, perhaps due to pressure from a key client or broker. This directly contravenes internal governance and regulatory mandates that require reinsurers to operate within defined risk parameters and capital constraints. Such an action could jeopardize the reinsurer's solvency and its ability to fulfill future obligations. The professional decision-making process for similar situations requires a systematic evaluation of the cedent's risk profile, a thorough understanding of the proposed reinsurance structure, and strict adherence to the reinsurer's underwriting guidelines and regulatory obligations. It involves open communication with the cedent and brokers to ensure mutual understanding of the risks and benefits, and a willingness to negotiate terms that are both commercially viable and regulatorily compliant. Question 17. Strategic planning requires a reinsurer to carefully consider its obligations under follow the fortunes and follow the settlement's clauses when a cedent settles a complex, high-value claim for an amount that, while within the policy limits, appears higher than the reinsurer's internal assessment of the claim's ultimate liability. The cedent asserts that the settlement was a necessary business decision to avoid protracted litigation and potential reputational damage. The reinsurer's claims team suspects the cedent may have been overly generous in its negotiation, potentially due to internal pressures or a desire to conclude the matter quickly. Given these circumstances, what is the most appropriate course of action for the reinsurer to uphold its contractual and ethical obligations? Option A. Conduct a thorough review of the cedent's claims handling process and documentation to ascertain if the settlement was a bona fide and reasonable compromise made in good faith, and if so, indemnify the cedent. Option B. Reject the claim settlement outright, citing the discrepancy between the settlement amount and the reinsurer's assessment of liability, and demand a more detailed justification from the cedent. Option C. Accept the claim settlement without further scrutiny, as the follow the fortunes clause mandates acceptance of the cedent's decisions, regardless of the amount. Option D. Renegotiate the settlement amount directly with the original policyholder, bypassing the cedent, to achieve a lower figure that aligns with the reinsurer's assessment. The correct answer is B. Reject the claim settlement outright, citing the discrepancy between the settlement amount and the reinsurer's assessment of liability, and demand a more detailed justification from the cedent. Explanation. This scenario presents a professional challenge due to the inherent tension between a reinsurer's obligation to follow the fortunes of the cedent and the potential for the cedent to engage in practices that might be considered imprudent or even unethical, especially when the reinsurer is not privy to all the underlying details. The follow the fortunes and follow the settlements clauses are cornerstones of reinsurance contracts, designed to provide certainty and efficiency. However, their interpretation can lead to disputes when the cedent's actions appear to deviate from sound underwriting or claims handling principles, or when the reinsurer suspects a lack of good faith. The professional challenge lies in balancing the contractual obligation to honor the cedent's decisions with the reinsurer's fiduciary duty to its own stakeholders and the principles of fair dealing. The correct approach involves a thorough and objective review of the cedent's claim settlement, focusing on whether the settlement, while perhaps not the absolute lowest possible amount, was a reasonable and bona fide settlement made in good faith by the cedent. This approach aligns with the spirit of the follow the fortunes and follow the settlements clauses, which generally oblige the reinsurer to accept the cedent's underwriting and claims decisions, provided they are made in good faith and within the bounds of the original policy and reinsurance contract. Regulatory frameworks, such as those governing insurance and reinsurance in the UK, emphasize good faith and fair dealing between parties. The Financial Conduct Authority, FCA in the UK, for instance, expects firms to act with integrity and in the best interests of their clients and the market. While specific follow the fortunes regulations are contractual, the underlying principle of good faith is a regulatory expectation. Therefore, accepting a settlement that appears reasonable and was made in good faith, even if it could have been lower, upholds the contractual intent and regulatory expectations of fair dealing. An incorrect approach would be to refuse to indemnify the cedent solely because the settlement amount exceeded what the reinsurer believes was the absolute minimum payable, without evidence of bad faith or a breach of the original policy terms. This disregards the practical realities of claims negotiation and the cedent's expertise in managing such processes. Ethically and regulatorily, this could be seen as a breach of the implied covenant of good faith and fair dealing inherent in reinsurance contracts. Another incorrect approach would be to accept the settlement without any review, even if there were clear indications of gross negligence or fraud by the cedent in the settlement process. While follow the fortunes is broad, it is not absolute and does not typically extend to covering losses arising from the cedent's deliberate misconduct or a complete abdication of its responsibilities. Such an approach would fail to protect the reinsurer's interests and could be seen as facilitating or condoning improper practices, which would be contrary to regulatory expectations of prudent risk management and market integrity. The professional decision-making process for similar situations should involve a multifaceted assessment. First, understand the precise wording of the follow the fortunes and follow the settlement's clauses in the specific reinsurance contract. Second, conduct a diligent review of the cedent's claims handling file, looking for evidence of good faith, reasonable investigation, and adherence to the terms of the underlying policy. Third, consider whether the settlement was a bona fide compromise of a disputed claim or a voluntary payment that was not legally or contractually required. Fourth, if there are concerns about the cedent's conduct, seek legal counsel to understand the extent to which the reinsurer can challenge the settlement under the contract and relevant law. The ultimate decision should be based on a balanced consideration of the contractual obligations, the evidence of the cedent's actions, and the overarching principles of good faith and fair dealing expected within the regulatory environment. Question 18. The audit findings indicate that the company has entered into a significant quota share reinsurance treaty, which has been presented as a primary driver for reducing its regulatory capital requirements. However, the auditor has raised concerns about whether the economic substance of this arrangement truly reflects a transfer of risk sufficient to warrant the claimed capital relief under the applicable regulatory framework. Which of the following approaches best addresses the auditor's concern and ensures compliance with regulatory capital management principles? Option A. Rely solely on the accounting treatment applied to the reinsurance contract, as this typically reflects the intended financial impact and is sufficient for regulatory reporting purposes. Option B. Immediately cease all reinsurance arrangements that are presented as providing capital relief until a comprehensive review of all existing treaties can be completed, without specific regard to the nature of each contract. Option C. Accept the reinsurer's confirmation that the treaty is structured to provide maximum capital benefits and adjust the company's capital accordingly, as the reinsurer is presumed to be knowledgeable about such arrangements. Option D. Conduct a detailed review of the quota share reinsurance contract's terms and conditions, focusing on clauses that define the transfer of risk, potential for risk retention by the cedent, and any finite features, to assess its alignment with the specific regulatory criteria for capital reduction. The correct answer is D. Conduct a detailed review of the quota share reinsurance contract's terms and conditions, focusing on clauses that define the transfer of risk, potential for risk retention by the cedent, and any finite features, to assess its alignment with the specific regulatory criteria for capital reduction. Explanation. This scenario is professionally challenging because it requires a deep understanding of how reinsurance arrangements impact a cedent's capital management strategies, specifically in relation to regulatory solvency requirements. The auditor's findings highlight a potential disconnect between the perceived capital relief from a reinsurance contract and its actual regulatory treatment. Professionals must exercise careful judgment to ensure that the chosen reinsurance structure genuinely supports the company's financial stability and meets all applicable regulatory capital standards, rather than merely creating an illusion of improved capital adequacy. The correct approach involves a thorough review of the specific reinsurance contract's terms and conditions against the relevant regulatory framework for capital assessment. This means verifying that the reinsurance contract meets the criteria for capital reduction as defined by the prudential regulator. For example, under UK regulations, a reinsurance contract must transfer genuine risk to the reinsurer and not contain features that effectively retain that risk, with the cedent for it to be recognized for capital purposes. This would involve examining clauses related to retrocession, finite elements, or termination provisions that might undermine the risk transfer. The regulatory justification lies in ensuring that policyholder protection is maintained by requiring insurers to hold sufficient capital against the risks they truly bear. An incorrect approach would be to assume that any reinsurance contract automatically reduces capital requirements. This fails to acknowledge that regulators scrutinize the economic substance of reinsurance arrangements, not just their form. If a contract is deemed not to transfer sufficient risk, or if it contains features that allow the cedent to retain the risk, it will not be recognized for capital relief. This can lead to regulatory breaches, fines, and reputational damage. Another incorrect approach is to focus solely on the accounting treatment of the reinsurance without considering its regulatory capital implications. While accounting standards may permit certain treatments, regulatory capital rules are often more stringent and designed to ensure a higher level of financial resilience. Relying on accounting treatment alone without regulatory validation is a significant oversight. A further incorrect approach is to rely on the reinsurer's assurances about the capital benefits without independent verification against the cedent's specific regulatory environment. The cedent has the ultimate responsibility to demonstrate compliance with its own jurisdiction's capital rules. The professional decision-making process for similar situations should involve a multidisciplinary approach. This includes close collaboration between the underwriting, finance, risk management, and compliance departments. A critical step is to engage with legal and actuarial experts who understand both the reinsurance contract and the specific regulatory capital framework. Before entering into any significant reinsurance agreement, a robust due diligence process should be undertaken to assess its capital impact, including seeking pre-approval from the regulator where necessary or appropriate. The focus must always be on genuine risk transfer and demonstrable compliance with regulatory capital requirements. Question 19. The efficiency study reveals that a significant portion of the reinsurance team's time is spent verifying the financial strength of reinsurers for which credit is being taken. To streamline this process, the team proposes to rely on the reinsurer's public credit ratings from a reputable agency and a verbal confirmation from the reinsurer's chief financial officer regarding the existence of a valid reinsurance contract. Rather than obtaining and reviewing the full, executed reinsurance agreement and detailed financial statements for each transaction, which of the following approaches best aligns with the regulatory requirements for granting credit for reinsurance? Option A. Rely on the reinsurer's public credit ratings and verbal confirmation of the reinsurance contract, as this demonstrates a reasonable effort to assess the reinsurer's financial standing and the existence of an agreement. Option B. Prioritize efficiency by accepting the reinsurer's public credit ratings as sufficient evidence of financial strength and assuming the existence of a valid contract based on past dealings, without requiring formal documentation for each instance. Option C. Obtain and meticulously review the executed reinsurance agreement and verifiable evidence of the reinsurer's financial strength, such as audited financial statements or regulatory filings, to ensure compliance with all stipulated requirements for credit for reinsurance. Option D. Accept the reinsurer's self-attestation of compliance with all regulatory requirements for credit for reinsurance, assuming that established business relationships imply adherence to standards. The correct answer is C. Obtain and meticulously review the executed reinsurance agreement and verifiable evidence of the reinsurer's financial strength, such as audited financial statements or regulatory filings, to ensure compliance with all stipulated requirements for credit for reinsurance. Explanation. This scenario presents a professional challenge because it requires a nuanced understanding of the regulatory framework governing credit for reinsurance, specifically concerning the documentation and evidence required to support such credit. The challenge lies in balancing the need for efficient business operations with the absolute requirement of regulatory compliance to ensure the solvency and stability of the ceding insurer. Misinterpreting or overlooking these requirements can lead to significant financial penalties, reputational damage, and potential regulatory intervention. The correct approach involves diligently ensuring that all documentation supporting the credit for reinsurance, particularly the reinsurance agreement itself and evidence of the reinsurer's financial strength, meets the explicit requirements of the specified regulatory framework. This approach is correct because it directly adheres to the principles of regulatory compliance, which mandate that insurers must hold adequate assets to cover their liabilities. Credit for reinsurance is a mechanism to reduce these liabilities, but it is contingent upon demonstrating that the reinsurer is financially capable of fulfilling its obligations. This requires verifiable proof, such as a properly executed contract and evidence of the reinsurer's solvency, as stipulated by the regulations. Failure to obtain and maintain this evidence undermines the validity of the credit taken and exposes the ceding insurer to undue risk. An incorrect approach would be to rely on informal understandings or incomplete documentation. This is a regulatory failure because it bypasses the established procedures designed to protect policyholders and the financial system. The absence of a formal, compliant reinsurance agreement means there is no legally binding contract to enforce the reinsurer's obligations, and a lack of evidence of the reinsurer's financial strength means the ceding insurer cannot demonstrate that the reinsurer is capable of paying claims. This directly contravenes the spirit and letter of regulations designed to ensure that credit for reinsurance is only granted when there is a high degree of certainty that the reinsurer will perform. Another incorrect approach would be to assume compliance based on a long-standing business relationship without periodic verification of the reinsurer's financial status. This is an ethical and regulatory failure, as it implies a complacency that can lead to significant exposure if the reinsurer's financial condition deteriorates. Regulations typically require ongoing monitoring and updated evidence of financial strength, not just initial due diligence. Professionals should adopt a decision-making process that prioritizes a thorough understanding of the specific regulatory requirements for credit for reinsurance. This involves proactively identifying all necessary documentation, establishing robust internal controls for its collection and maintenance, and conducting regular reviews to ensure ongoing compliance. When in doubt, seeking clarification from regulatory bodies or legal counsel specializing in insurance regulation is paramount. The focus should always be on demonstrable compliance rather than assumptions or expediency. Question 20. Compliance review shows that a UK-domiciled cedent, which has entered into a reinsurance treaty with an insolvency clause, has recently filed for administration. The cedent has outstanding claims from its policyholders that it is unable to settle due to its financial difficulties. The reinsurer is now considering its obligations under the reinsurance treaty. Which of the following represents the most appropriate course of action for the reinsurer? Option A. Propose to the cedent's administrator a revised payment schedule for reinsurance claims that deviates from the terms of the insolvency clause, given the cedent's distressed financial state. Option B. Conduct a detailed review of the specific wording of the insolvency clause within the reinsurance treaty and assess whether the cedent has met its primary obligations to policyholders as stipulated by the clause before making any payment. Option C. Withhold all reinsurance payments indefinitely until the cedent's administration process is fully concluded, citing the cedent's insolvency as grounds for non-payment. Option D. Immediately pay all outstanding reinsurance claims to the cedent's administrator to ensure policyholder protection, regardless of the specific wording of the insolvency clause. The correct answer is D. Immediately pay all outstanding reinsurance claims to the cedent's administrator to ensure policyholder protection, regardless of the specific wording of the insolvency clause. Explanation. This scenario presents a professional challenge because it requires a nuanced understanding of the insolvency clause's practical application in a reinsurance context, specifically when a cedent faces financial distress. The challenge lies in balancing the cedent's need for timely claims payment with the reinsurer's obligation to pay only after the cedent has fulfilled its own obligations, while also adhering to the spirit of the reinsurance contract, which is to provide financial relief. Careful judgment is required to interpret the clause accurately and apply it in a manner that is both legally sound and ethically responsible, avoiding actions that could be construed as prejudicing either party. The correct approach involves a thorough review of the specific wording of the insolvency clause within the reinsurance agreement and relevant UK regulatory guidance, such as that provided by the Financial Conduct Authority, FCA, and the Prudential Regulation Authority, PRA, concerning solvency and capital requirements for insurers. This approach correctly recognizes that the insolvency clause is designed to protect the reinsurer from paying claims before the cedent has demonstrably met its primary obligations to the original policyholder. It also acknowledges that the clause does not absolve the reinsurer of its liability, but rather defines the trigger for payment. The regulatory framework emphasizes the importance of contractual certainty and the proper functioning of the insurance market, which includes ensuring that reinsurers fulfill their obligations in accordance with the contract, even in situations of cedent insolvency, provided the conditions of the clause are met. An incorrect approach of immediately withholding payment based solely on the cedent's insolvency filing, without a detailed examination of the clause's specific conditions and the cedent's actual payment status to policyholders, fails to uphold the contractual agreement. This could lead to a breach of contract and potentially violate regulatory expectations regarding the orderly settlement of claims. Another incorrect approach, that of paying claims irrespective of the insolvency clause's conditions, would expose the reinsurer to undue financial risk and contravene the protective intent of the clause, potentially leading to regulatory scrutiny for imprudent risk management. A third incorrect approach, which is to seek to renegotiate the clause's terms retroactively due to the cedent's insolvency, is ethically questionable and contractually unsound, as it attempts to alter agreed-upon terms under duress and undermines the principle of contractual good faith. Professional decision-making in such situations requires a systematic process. First, meticulously review the specific insolvency clause in the reinsurance contract. Second, consult relevant UK regulatory guidance and legal interpretations concerning such clauses. Third, assess the cedent's current financial position and its actions regarding policyholder claims. Fourth, communicate transparently with the cedent to understand the situation and explore potential resolutions that align with the contract and regulatory expectations. Finally, seek legal counsel if there is any ambiguity or dispute regarding the interpretation or application of the clause.